Okay, question and answer time from the last market outlook. What's your process for learning a new sector or industry group? I know you talked about your high level structure, but what does it look like for you in terms of where you start your research process and how you compile these initial 50 pages of notes? Do you essentially start with industry primers, trade associations, equity research reports, 10Ks, and sector industry outlooks? How do you know that you've gathered enough info so that you can start condensing it instead of continuing to research further? Well, your list is pretty good. I pretty much start with 10Ks. I find the largest companies in that sub industry, and I go right to their 10Ks. And then that will tell me, as I'm reading it, I'll come across things I don't understand, or terminology I don't quite get, or a business model I don't quite understand, and that means that I've got to go looking for stuff. Great places to look for things are any of the trade associations. There's always a bunch of those. Another great research is the Bureau of Economic Analysis. You can find out a lot in terms of industry structure from BEA. So it can give you something like, I'm still working on healthcare, for example. So it gives me a nice breakdown of the types of not symptoms, but the types of conditions that are treated, and the types of drugs that are used, and the size of each of those particular markets. Now that's a lot of bottom-up detail if I wanted to go through like a Pfizer and look at its drug and look at its market potential in the US. But it gives me an idea of the broad groupings. A lot of good information out there. You just got to use Google and then trust the source that you get to. But yes, I use trade associations. Not so much equity research reports. I don't read a lot of that because it's really forward-looking. It doesn't really give me what I'm looking for. 10Ks, yes. Sector industry outlooks at the very end. Not early in the process, at the very end, because usually they're forecasting a trend or something that they see, and it's, it may not reflect where the industry is today. So if you start with 10Ks and every time you come across something you don't understand, you stop and you hit Google. Look for good sources and just keep doing it that way. How do I know when to stop? Is when I start with the big ones and then I start with smaller ones, and when I get to a 10K that I can read and I'm not having to go look for anything, that's when I know that I'm done, because I now understand what I'm reading. 2 questions. Will the applied series be available within a year or 2? Yes, they will. And are they made to still be relevant? So this is the dilemma I have every time I do one of these. Is there is certain truths that will last for time. So when for example, in the pharmaceutical video that I'm doing now, I'm going to give you the difference between generic and brands, and the difference between biosimilars and biologics. That continues on. That doesn't change. That will be what it will be. But then I will give you growth rates of biologics. I will give you market share of generics versus brands, while that unfortunately is specific to the time period I happen to be in. But it's important to know where the growth in the sector is. Is the growth happening in the biopharma space, or is it happening in the pharma space? And in the pharma space, where's the money? Is it in the generics or is it in the brands? That's specific to right now. That in 5 years, that may change. Those growth rates may change. But you should be able to find that information on your own, because now you know, well, that's the information I need to find. 80 to 90% of answering your question is knowing what your question is to begin with. Spend a lot of time on the question. The answer is usually straightforward, but you have to ask the right questions. So as you go through the video, some things will endure over time, like definitions of generics, brands, biologics, biosimilars. That will last through time. The market share of each, the growth rate of each, the margins on each, yeah, that may endure for a period of time, or it may be specific to a point in time. That's a trade-off. Sometimes it's difficult to talk about an industry without bringing in time-sensitive information, like market shares, like growth rates. Well, they are for that period of time. So let's say that we're 2028. And you're reviewing a video that I had done in 2023. Most of it will be relevant in 2028. What is not relevant are, facts and figures from 2023. But now that you know, okay, well, the market share of generics is 90% in the U.S. By the way, that is true of all the drugs in the U.S. Generics make up 90%. 9 out of 10 prescriptions are generics. Well, if it were 2028, you would then Google generic share of U.S. drug market and see if it's still that 90%. Let's see, next question here. First question. Would like to learn the material and see your approach, however, to keep up with the family, full-time job, CFA level 2, and health is already a stretch. Yeah, so the question is, within a year or two, are they still relevant? Yes, they are. Been following your weekly updates for some time. NOAS market activity. Small movements, so the balance sheets are strong. Though we are seeing that companies are using accounting tools to sustain earnings, that's true. With all the options for hedging, fintechs, insurance, packaged products, are there any significant risks going on behind the scenes that do not appear on the surface? How do you dissect any huge players that can influence OAS? The OAS, the numbers I give are for a whole category, are for a certain credit rating of bond that's made up of a whole bunch of different companies. So I don't know that there is a way to assess it based on the influence one company could have on the whole credit rating. And if there is a company that has an influence, maybe it doesn't deserve that credit rating. Maybe it's ready for an upgrade or a downgrade. I don't know. I seem to think that type of focus, this pathway, I don't know, has a lot of runway to it. I don't know that I would go down that pathway if I were looking at the OAS as a class on a particular credit rating. Okay, question I have. Don't quite understand the home builder move during the week. Wouldn't an anticipated decrease in mortgage rates foreshadow a change in the structural shortage? Not really, because you would have to get the mortgage rates 250 basis points lower. A lot of people have mortgage rates that are locked in, well below 4%. So you're sitting at higher than that, right? You're in the sevens right now. I think 7.7%. So even if this dropped to 6.7%, 100 basis points, you're still not going to convince a lot of mortgage holders at sub 4% to upgrade to a bigger house, pay off their cheap mortgage, and take on a more expensive mortgage. So no, mortgage rates would have to fall a considerable amount to increase the amount of prepayments. So prepayments meaning that you have existing homeowners that are selling and paying off their existing mortgage to get into newer mortgages. So no, it would be quite some time. It's going to be a home builder market for at 7.7 for at least 300 basis points down on mortgage rates. It's going to be a home builder market. Great to see Mark on the All-In Pod. Yeah, they're I'm not in that league, eh? Those are billionaires. Those are billionaires talking. I'm not in that league at all. So, although it would be, I think it would be kind of neat. I don't see that. I'm I'm too small to be on their radar at all, and I'm not really in their space, their venture capital space. Is it possible to add a feature on your QBank that allows you to filter your flag questions by module? This, I would, anything about the business, I would use support at markmeldrum.com. As you are mostly aware, or most of you are aware, I sold the business April 1st, 2022 to Serify. So I don't own it anymore. So features and things like this are out of my influence. What are your thoughts on Chinese and UK equities? I don't know much about any other market than the US, so I don't really have thoughts. I don't even know where the UK market is trading at or where the Chinese market is trading at. I have no clue. The valuations historically very low levels. Do you think their current economic outlooks justify these? Not a clue. I'd say the same thing about Canadian market. If you ask me where the TSX has finished this year, I would say I have no idea. I don't know if it's up. I don't know if it's down. I have no idea. And I live in Canada, but I'm not an expert on the Canadian market at all. I've spent almost no time in it other than for the occasional REIT stock. Other than that, I know nothing about it. Many potential downsides to the equity market. What would you see as potential upsides for the stock market? Probably the biggest one that I've seen was the productivity report from last week, showing productivity up at 4.7%, and that's quarter over quarter. I mean, that's a pretty big jump. You have negative unit costs. The unit labor costs are negative because productivity is outstripping the average wage gains. That's bullish for increasing margins. Now, we just haven't really seen that translated into earnings yet. So I'm not really sure what a big tailwind would be. The fact that there's a growing consensus that the Fed is done and now they're going sideways for a while. The next move is more likely down than up. Even though it might be 2-3 quarters away, it's more likely down. That's a tailwind. At any given time, there's headwinds and tailwinds. You have positive economic growth still. That's a tailwind. If it wasn't for the high level of rates globally, I don't know that I would be concerned about being all in on equities right now. So I'd say the tailwind would be increasing productivity gains, which is deflationary, followed by rate cuts. And if that can happen without something significant breaking globally or economically in markets somewhere, then that would be bullish. I'm still queasy in deploying capital to my strategic asset allocation passive equity position. Well, what's your time frame? If your time frame is 3 years, then that's tough. 3 years. But if your time frame is 20 years, who cares? If you look at the history of S&P, there's the beginning. Here we are now. It's done this. So like it doesn't just go straight up. It has these little things, but it always tends to that if you just drew a trend line in there, cycles in around that trend line. Timing the market is brutally difficult for a passive sleeve. Just buy at regular intervals is what I would suggest. So what is your time frame? If your time frame is long, if you have a long-term horizon, which is long-term is considered 15 years or more, then don't try to time your entry. In 15 years, it's not going to matter that much, really. Fundamentals don't support much in equities right now, but you can, you can still be defensive. It may not support, it maybe not support a beta of 1, but it may be okay for a beta of 0.8. Just find defensive stocks, and when you see the central bank starting to cut rates because inflation is going away and the economy is slow but still growing, that's when you want to move into high beta. If they're cutting rates because something broke, you're going to be happy that you're in low beta. But to not have exposure, no, I wouldn't do that. 30-year fixed rate mortgage to 10-year Treasury spread increased 16, but agency price increased despite the spread. Well, because it had sold off so much. When we find a relationship in the market, they are not deterministic. Okay, they are probabilistic, which means there is a probability that they move in a certain way, but that doesn't mean that they do it on every single observation. So if there's a relationship between a spread and the valuation of a particular equity, that does not mean that equity will move in lockstep with the spread. It just means that over time, it has a very good relationship with the spread, but it's still probabilistic. So I wouldn't look for something happening every single day. In fact, on a day-to-day basis, I would try to avoid attributing a reason to moves. Oh, it moved because of this, or it did this because of that, or because of this. It could simply be that somebody somewhere decided to buy, somebody somewhere decided to sell. And they were willing to move the price as they did it. It could just be something technical like that, just some buying or selling, or it could just be one of those things where a bunch of small players that otherwise couldn't move the stock just coincidentally decided to sell it the same day in around the same time. These things happen. So it's not as if moves have reasons all the time. But the market is probabilistic, which means it's not going to hold to a relationship every single day very, very tightly. If it did, we would not be needed. Algorithms would just do everything. We would not be needed at all. Which is better in expressing a short position on MBS spread to go long MBB or agency? Agency uses leverage, right? We'll call it close to 8 times leverage. MBB does not use leverage. MBB is just the bond. In which case, I would say, see if you can't just buy a mortgage-backed security yourself and save the management fees. Right? Just see if you can't buy one. Any thoughts on being involved in picking, this sounds familiar, picking the PE hedge fund manager for an insurance company's general account as a career? Well, I guess. I have no thoughts on it. Are the exit opportunities similar to... I've answered this before. My answer is I have no idea. I don't know what the exit opportunities are for investment banking analysts to do that, so I wouldn't know. No clue. Where the risk-free rate comes from the market. It comes from the market setting... basically the Treasury market. In your market outlook explained video, you mentioned the risk-free rate comes from the par curve. No, I didn't. Yields, I point out the yields every week. The yields come from the par curve, but those are yields on coupon-paying bonds. That's what the par curve is for coupon-paying bonds. You can you can look for strips and you can construct a zero curve. That would be a spot curve, or you can you can bootstrap the spot curve by looking at the par curve and figuring out, well, what would each spot rate be? But no, I didn't say the risk-free rates come from the par curve. The yields on treasuries come from the par curve. I don't know that I use the word risk-free rate when I refer to them. My understanding of level 1 content shows using spot rates for the risk-free rate for the questions. I assume CFA curriculum simplifies things to make understanding easier. Could you explain? It'll also be appropriate to say that the entire spot par, well, those are two different things, is determined based on market demand for T-bills, treasuries. Well, not T-bills, treasuries, right? Treasuries. And what firms are willing to pay for those rates are based on the overnight rate. Money markets. Yeah, the money market rates, which are tenors of 1 year or less, will reflect where the effective federal funds rate is. But the capital market rates, other than the 2-year importing some monetary policy, the further you go out on the capital market curve, the less likely it is that it's being influenced by the effective funds rate, the effective federal funds rate. Concepts make sense to me in isolation, but together I'm having trouble to see how they all affect and impact each other and the order of what determines the prices and rates. Don't worry about spots. Just pay attention to the yields. Spots are important if you want to discount a particular cash flow at a particular point in time. Then, that's the price for a $1 investment in 10 years. That for 10 years you're not going to get anything, then you're going to get $1 in 10 years. You want a 10-year spot to discount that. But, other than in valuation, I don't know that for a retail investor you're going to need that very much. Institutional wise, you're never going to have to figure out a spot rate. You look at your screen and you'll have your spot rates. You just have to know that spot rates are for a single cash flow, whereas the yields at a certain point in time are for a coupon paying bond. It's the yield that makes the bond trade at par. In other words, if the bond had a coupon equal to the yield, it would trade at par. Or another way to say it is, if a bond was issued that day, a 10-year bond was issued that day at par, its coupon would be whatever the yield happens to be. Not sure if you saw Stan Druckenmiller's interview on CNBC last Wednesday. Could you share your thoughts on his comments? He seemed quite passionate on his disappointment in yelling the Treasury over the past 2 years. Yeah, well, he had, I'd say I'm with him 25% of the way. That why not extend duration at that time? Okay. However, the Treasury market is not the same as an investment grade market. So he was making a juxtaposition there, saying, listen, you had companies that termed out their debt and they're basically immune from the interest rate hikes. Their interest expense isn't increasing at this point. They've termed out their debt. Why didn't the Treasury do the same thing? Companies and governments are two very different entities. Companies have balance sheets. Companies raise capital with both equity and with debt. And they use debt for all sorts of reasons, to shore up their balance sheet, to buy back equity, to maintain a debt equity ratio. And yeah, there was a lot of issuance when interest rates were very, very low. Valuations were pricey, and it just made sense to issue debt and buy back. If you were going to do a stock buyback before the tax came in, a lot of that was done for that. Governments don't have balance sheets, and they are repeat issuers, not single issuers. So a company, an investment grade company that issues a 15-year bond, issues a 15-year bond, and it's done. They don't have to worry about the clientele. They don't have to worry about the supply of the bond that they're issuing. And they don't have to worry about the market for their 15-year bond on a repetitive basis, because they're not issuing a 15-year bond every 3 months or every 4 months. The Treasury has to. So it has, it has T-bills. Then it issues a 2, a 3, a 5, a 7, a 10. And that's a very particular market. Probably I'd split it in two. Then it has a 20 and a 30. And there are different clienteles for each of these particular markets, and some of these are benchmarks. The 10, the 5, the 2, these are all called benchmark rates, but these are particular benchmarks for particular things. You can't just say, okay, you know what I'm going to do? I think that rates are going to go up, so let's just issue a bunch of 30 years. You will hollow out the T-bill market. Well, there are money market funds and repo markets that depend very heavily on this. You are going to mess shit up. And if you say, well, let's not do T-bills, let's do the 10-year, you will change the yield on the 10-year. You will increase it dramatically by increasing that much supply on the 10-year, because these customers are not customers of the 10-year. Money market funds aren't going to buy the 10-year. So you are flooding this market with a whole bunch of issuance, and you're going to ruin the price signal that the 10-year may be giving to the mortgage market, and you're going to mess things up. So you can't just go throwing things around. Every sector, every section of the yield curve has a particular reason and a particular clientele in there. You can't overwhelm them with supply, because the clientele may not be large enough to absorb that supply. So you're limited to where on the curve you can go with everything. You can't just say, well, I'm gonna issue debt. Some companies issued 15-year debt and bought out their 3-year debt. Well, none of this stuff is callable. You can't do that. You're not going to issue a whole bunch of 30-year debt and buy back T-bills because you think rates are going up. You will cause so much dislocation in markets. You'll mess things up. So because of that, it becomes very difficult to do that kind of thing. Not only that, let's go, here we are looking backwards. Everything is great looking backwards. We're all Monday morning quarterbacks looking backwards. He should have passed. I don't know what he was thinking. Yeah, she should have extended it. Listen, 2021, you had a buyer, the Fed, who was buying everything. You had, beginning of 2021 to mid-2021, you really had no inkling of inflation. It really didn't start showing up till the end of 2021. You had a Fed that was still buying and that had, for the last 15 years, done nothing, kept rates pretty much at the low end. So are you going to say, look, I'm not going to issue 2-year notes at 50 basis points. I'm not going to do that. I'm going to issue 30 years at 2.6%, right? Who would do that at that time without the foresight, without knowing what would happen? You got to put yourself back at that point in time and say, well, why would I do that? And again, you have to keep your markets happy. You have to, there are clientele effects in each one of these. There are particular markets on each one of these. You can't just wholesale move everything to the long end of the curve. So his criticism rests on, I think, a lack of understanding of the specific types of markets and the market dislocations you could cause by doing something to the extent that you think you can get it done. And two, it presupposes that there was vision from the Treasury at that point in time to see that all of this would have happened. Now you can say, but corporations saw that. Did they? Or did they just take advantage of a low rate environment to fortress up their balance sheet, especially after the COVID issue happened and the whole economy shut down? Did they react to what had just happened, or were they seeing that, oh my God, this is going to be so inflationary, let's do this now, rates are going up to 6%. Maybe there's a company or two in there that did that, but listen, if you say what's going to happen in 5 years, you're going to get this kind of forecast, right? You're going to get this kind of forecast. Well, somebody's going to be right. Statistically, somebody's going to be right, but did that make them more visionary than everybody else? Or if you get enough forecasts, is statistically somebody going to be right? So when you're standing over here looking backwards saying, oh my God, they were such failures, I don't know that I would say that. What were you going to do over here? Those have very particular markets. Those are required. Those are a source of liquidity. You're just going to say, okay, no more T-bills? Oh my God, what are you going to do to those particular markets? The damage you would cause, right? But if Apple issues a 15-year bond or a 20-year bond or a 30-year bond and says, well, instead of 50 billion, let's bring it to 70 billion, and instead of 15, let's go to 30, it's not going to cause any dislocation in the 15-year investment grade market because, well, there is none really. There's a clientele for investment grade bonds, but not for any particular part of the maturity spectrum, right? So it's not going to cause any dislocation if Apple decides to change its mind, or if JP Morgan decides to change his mind, or Alcoa decides to change his mind. But it will cause a lot of damage and a lot of dislocations if the Treasury changes its mind. That's why the Treasury every quarter releases its refunding statement to let the market know, to give market clear visibility on where it's going to issue and how much it's going to issue, because so much depends on that Treasury market that you have to give it that visibility, and then you got to stick with it. Now, saying that you could extend is also presupposing that you can change the allocation of each of these. Typically, this used to be anywhere from 15 to 20% would be here. So there are well-stated distributions. And that is assuming that one person can say, well, let's just scrap it all and I'm going to do it. There's also an average duration for all of the debt issued, and there is a supposition that there isn't some kind of restriction in the amount of duration that you can have. Now, I don't know if there is or isn't, but just to say, from the perch of today, looking back 2 years, and to criticize somebody for not doing something in a government role that companies did, I don't know. Now, I know that he's been around a long time and he's well respected, but it seems to me that it showed that maybe he's not a government bond person, maybe he's a debt person, and maybe he's a company person, but it's a kind of a lack of understanding of how the government T-bill, T-note, and T-bond market work, I think. So, I don't know. I'm going to say, okay, yeah, you got a point. Maybe there should have been some effort to extend duration, but at the same time, by how much? You can't call these bonds, so all you have is the issuance at that time. So what are we talking about? 2 years of issuance, and you're going to change trillions and trillions of dollars of outstanding debt that you can't call? How are you going to get that done? You can't call it. You can't retire it. So incrementally, all you could do is continue to issue. Incrementally, now, what could Yellen do when the government is deciding on a debt ceiling thing? The Treasury can't go past Congress and do whatever the hell it wants to do. Companies can. Companies don't have a Congress. They can do whatever the hell they want to do. They just have to vote on it, and that's it. They're done. But Yellen can't. So, yeah, I'd be sort of 75% against what he said, 25% with, well, okay, you know. I mean, there was a point in 2022 where it was clear the Fed was going to go much higher for longer. Yeah, maybe there should have been a little bit more pushed into the 20 and the 30. But the Fed was letting issuance run off at the time, which complicates your job a little bit more. You need a market for the debt that you're issuing. You can't overwhelm your 30-year market and underwhelm your T-bill market. Do you see where I'm going with this? Right? So, yeah, we'll leave it at that. Is forward 4-quarter operating earning including energy? Yeah, I don't know why it wouldn't. It appears most sectors in S&P are expected to have decent earnings growth in the next quarter, besides energy and healthcare. Yeah, healthcare still has a bit of a... Healthcare is a funny... Like, when you really start to dive into the sector, you start to see how funny a sector it is. Volumes increase, but it still is under pressure. Big problem in the generics market as well. So it's a funny business. At a high level, it appears corporate earnings are going to continue to best estimates. Well, if you keep lowering your estimates, yeah, and see growth through the next 4 quarters. Well, let's be careful. Just because you beat estimates doesn't mean you grew your earnings. right? I mean, if I made $1 last year and my estimate is 40 cents and I came in at 50, hey, I beat estimates by quite a bit, but my earnings are down 50% year over year. That's not growth. Beating estimates and growth are two different things, right? So beating estimates is just an estimate. Now, to say that you have growth, that estimate must have been higher than last quarter or last year's quarter for you to say that they're a growth. Context behind these estimates are calculated would be helpful. They're bottom up estimates, the consensus of the estimates of the analysts who follow each of those stocks. So it's the consensus of, let's say, take Apple, 27 analysts, 30 analysts. What's the consensus earnings? That becomes the earnings for Apple added to the earnings for AMD, to Intel, and then on it goes, right? How ABR generates cash flows? Well, it lends money and charges interest. And it also has, it originates and sells mortgages, and then it services the mortgage. And when you service, you get basis points on the total value that's outstanding. Plus, it earns interest on the payments it receives before it sends it to the government agencies. So once a month it sends all the money. I think it's every 2 weeks it sends all the money to the government agencies, but it gets payments every single day. So it has a balance sometimes of $1.5, $2 billion sitting in the bank before it sends it off. Well, during this period of time, it earns interest on that. It has I don't know how many billions now its mortgage servicing is, but it may collect. It may get 30 basis points, maybe even 50 basis points for servicing all the mortgages. Now, it doesn't own the mortgages. It just services the mortgage. In other words, it collects the money from the mortgage holder and gives it to the agency. If a mortgage holder defaults, it doesn't hurt ABR. The only risk it has is the money it actually lends out. What do you think of the current price? Our ABR for years and years gets almost no respect. And they continue to perform. They continue to beat their estimates. They continue to pay their dividend and increase their dividend. Over the years, that dividend has gone straight up. If you go back to 10 years ago, it was 12 cents a share. Now it's 43 cents a share. But they still get no respect. I don't understand why, but I keep owning it and it keeps paying. And every now and then it gets a little bit of respect and it goes up in price. But overall, it gets no respect. When I get these nice big dividends, I simply just reinvest. I mean, why not? I have no problem with this stock. If I buy the applied series, now do I maintain access to it forever? Yeah, at some point that will end, but not for the people who bought it. So if I draw a timeline, right, I plan to keep going with it. I'm going to continue to add. And what the feedback I'm getting is from the sector studies, especially the understanding videos, where I, like I've done understanding mining, understanding utilities, understanding banking, understanding semiconductor. I keep getting a lot of great feedback on that. So with 163 sub-industries, there is a long tail in front of me of videos that I can keep adding just to that section. So I will continue to add those. But at some point, I'm going to stop. The pricing is going to change. Right now, we're way back here, right? And you pay $320. Anybody who buys the applied series, you have it forever. But the number of subscribers is beginning to do this. Starting to climb. It will get to a point where the size of the subscriber base and the cost of continually streaming is going to begin to weigh, which means I'm going to have to find some different revenue model in the future. Since I'm still building the applied series, I figure you're willing to make a bet on me this early. your reward is you'll be grandfathered in. As of this date, all the subscribers that have happened here will experience no extra charge. At this point in time, it will change to something else. I just don't know what yet, and I don't know when this point in time is. I do know this: December 1st, this 320 goes to 440 because there is significantly more value in there and a lot more value left to come. So it does have to start reflecting the value that it does have, and the cost of maintaining a larger and larger shareholder subscriber base. International student finding a job in U.S. Will I be including the labor force? Does that number only include U.S. residents? No, well, I mean, you specifically, no. You statistically, yes. So it has some estimate of how population grows, and that population is for births, deaths, immigration, emigration, and those who are just residents, new residents. And then it has some estimate of what proportion of people are in the labor force. So you're not counted each month by, a show of hands, right? It's just a lot of statistical assumptions that go into it, and that's it. So it's not as if you will be counted, but your category is included. Yes. Given that the no rate hike scenario is almost locked in for December, according to you, what is something that might change the Fed's mind and prompt them to increase rates again in the future? Significant pop in inflation, like a big pop in inflation, would probably do it. If you had any perspective on Ellington Residential Mortgage REIT, no, I don't. Never heard of it. Would you recommend constructing an allocation factory on TLT given the Fed tone this past week? Yeah, I think so. I think we've seen the high level for rates. The Treasury refunding came in pretty well. I think the 3-year today went off nicely. There was no issue on the 3-year. We got more auctions this week. I think you have the 5, the 7, the 10 this week as well. But there seemed to be uptake on them. Asset allocation strategy differs across registered, LIRA, TFSAs, and non-registered accounts. Well, in RSPs, LIRAs, TFSAs, they're long only. No leverage, no derivatives, no short positions. They're long only. So it's mostly REITs in there because then you avoid all the taxation. And when I take the money out of the LIRA or the RSP when I retire, I got to pay income on everything. So I don't want to earn any income that would have been taxed at a lower rate only to take it out and pay tax at a higher rate. So you may as well earn income in there that would have been taxed at your highest rate anyways, which is non-qualified dividends, in other words, dividends from REITs, and interest income. So in my RSP through Interactive Brokers, I put U.S. Treasuries in there because I can hold U.S. dollar securities in there, and I figure, well, I'm leaving the country and probably not going to, I can't trade it, right? Once you leave, you can't add to it, and you can't really do anything with it. I don't need it for another 10 years, 15 years, so you want to put something in there that you're okay with. In lieu of what may now be a shift to the for how long paradigm from the how high, what's your take on ZPR? 1/3 of the underlying portfolio rolling over the next year to what looks like an implied 9.5. Yeah, they reset, their rate resets. They reset based on, I think, the 5-year plus a spread. Because the preferreds in them are rate reset preferreds. So they're dividend resets. And they will reset higher, yeah. I like ZPR. I like the little guy. It pays. And, I think about it this way. Imagine that you had a job and your job gave you a paycheck every week. You can calculate the present value of all your future income, right? You can calculate that. You just need some spot rates, and you can discount all of those future payments. It would be tedious to do, but you could figure out what the present value of your future earnings would be. If interest rates increased, the present value of those earnings would be lower. Would you quit your job? Right? I mean, you wouldn't, because it's the paycheck you're there for. I mean, you're not going to be knocked out just because, well, interest rates are higher, the present value of my income is lower, I should quit my job now. But somehow we want to sell stocks that are income stocks just because their present value is lower. We want to fire them. Okay, I'm going to fire my money. I don't want it having this job anymore, because you wouldn't quit your job. So if this is a long-term hold as an income generator, then every time you get the dividend, buy more. The holdings in here are all pretty much utility and bank preferred shares. In Canada, these are probably safer than government debt. So I'm unconcerned with ZPR. Please make videos on chemicals and auto sector. Chemicals, yeah, because you have basic and specialty, and that's can be a messy market. Auto sector, I don't know that you'll find an easier company to analyze than an auto company. Revenues minus cost of goods sold. Cost of goods sold is just the parts. Heavy asset presence, so lots of depreciation, labor cost. You can open up GM or Ford's 10K and start reading it and not be tripped up on anything you come across. You can read and go, okay, well, I understand what's going on here. It's not as if you have to say, hang on a second, I don't understand this. How are you doing this? How does this work? What is this thing? How are you making money this way? So, I don't know that there's an easier, well, actually, Best Buy is probably just as easy to understand as well. I mean, Best Buy, you can just pick up their 10K and start reading and not get tripped up on anything. So the auto sector, there's not a lot to figure out there. Highest conviction long out of the following as rates start to come down. XLU, IYR, no, not IYR, not small caps, high beta tech, probably XLU. If I had to pick out of those, I'd probably go two ways. I'd avoid IYR and small cap. I'd go XLU and high beta. Keep in mind you had a WeWork declared bankruptcy. At one point, they were the largest tenant in the U.S., the largest tenant. So there's a lot of buildings and a lot of office space that is going to be coming due. Well, not due, just that's it. It's over. I'd go XLU because I think the asset growth in utilities is going to be great, and they took a hit only because yields increased. Not because their business suffered, because yields increased. As yields decrease, XLU will be a beneficiary. Good dividend growth, 5-6% dividend growth. I'd grab XLU. And well, you got to be in tech, I think, because we are entering every day a more and more digital world. So you have to be there. What kind of rally we will see going forward in the equity market? No idea. Will be like April when everything went up. April was going nowhere till Nvidia. And then it was AI, and that was it. AI. Every company found a way to say AI until that rally petered out, and then we had what we had the last couple of months, which was we're down 10% from the 4,600 that it hit, and there's still a question of whether or not what we saw last week is going to be persistent, or whether we're going to fade away into the end of the year. So I don't know that you'd need another story that could affect every company. I don't know that you'll get that. It will be a more subtle rally this time with only a few sectors and quality names. I don't know. Do you plan on appearing on All In? The second one. I mean, first of all, it's not my choice. It's like, do I plan on appearing? It's not my choice. You have to be invited. And again, I don't think that I'm on their radar because I'm not in their space. You explained in a session some time ago that the path between booming inflation rate hike and recession disinflation cut is so narrow that a soft landing looks impossible. Is this logic still valid today? Yeah, I think it is. If you keep these rates at this level, you are going to damage things. You are. Companies, larger companies, have adapted to this environment before this environment showed up. In other words, they are already adapted for the environment that they're in. But a lot of companies have not adapted to this environment, and small business is the largest employer by far. Maybe by head count per business, not really, but by far they're the largest business. And we only see public markets. You have to start thinking about all the private businesses that you don't see. And I hear more and more about trouble and about difficulty in making it, just because of the high cost of the debt, and most of them do have debt. The increase in rents that they've seen, the increase in wages that they've seen, the difficulty of raising their prices. So, I think that getting away without a hard landing, I'd put a low probability on that. But then again, 2023 has been the year of low probability events, so it could happen. Is there a podcast version of your video? Would be great to have an audio version to listen to as well. I've always said that if you want a podcast version, just go to YouTube, hit play, and then look away. And there you go. But no, what I do requires so much visual stuff that a podcast would just be lost. What are your thoughts on the impact of First Quantum's sell-off on the broader copper mining market? You think this represents a stock-specific risk, or do you believe more governments will review their contracts with miners? Well, this is Panama, right? It's very specific to Panama. And the Panamanians are really upset about the really sweet deal that First Quantum got, and they want it revoked. And I think right near the end of October, the president announced that, you know what, we're going to put it up for a referendum, and the vote, I think, is early December. And the Panamanians will vote whether or not they get to renew that contract. And if they don't, this is their largest mine, and I think it's like just a little under 2% of all the world's copper comes out of that mine. 1.5% to 2% of the copper coming out of that mine. That's an existential threat for a company, right? That's an existential threat. So that's a big deal, and they'll be under pressure till December 7th. And if the vote falls in line with the outrage and the protests in Panama over this thing, then yeah, they lose it. The other big issue is the Panama Canal. It's not easy to get your stuff through the Panama Canal at this point in time. So if you're in Panama, you got to get this stuff to the world market somehow. It's brutally expensive to get your ship through the Panama Canal. So they got it on both sides there economically, in terms of the cost of moving their stuff out, and with this referendum coming up. Not only that, on their last earnings, they guided down production on copper, nickel, and gold. Nickel and gold quite substantially, and they guided up quite significantly on their unit costs on copper, gold, and nickel. So guided production down, guided their costs up, so revenues down, gross margins shrinking, and their biggest copper mine is now in the hands of the Panamanian voters on this referendum on December 7th. December 7th, I think it is. So it is very, very stock specific. Any chance you'll cover Berkshire? Not really. Berkshire's not a company per se. They're a holding company. You call it private equity, really. A mix of private and public equity. They just hold a bunch of other companies. So there's no point in covering Berkshire. First of all, you don't have any visibility in any of the companies. Have you seen Berkshire's income statement, what, 4 lines long, 5 lines long. You have no visibility into it whatsoever. All they are is just one big portfolio. So it wouldn't be worth covering. Who's on your Mount Rushmore of investors? You need 4 people. I would have to say, well, Warren Buffett would have to be there. Howard Marks would have to be there. I don't know. I don't know. I don't know that I've liked enough other investors for a long enough period of time to say that, yeah, I'd put them there. I don't know. There's 2. At what pace do you think interest rates would fall if there's no recession? I don't know. It depends on how inflation falls. If inflation falls very quickly and starts printing negative numbers, rates will fall very, very fast, because the only thing central banks fear more than rapid inflation is deflation. That is the biggest fear they have. They will cut rates very quickly. Do you see more opportunities in REITs or utilities over the next 3 to 5 years? Utilities. Why? Because utilities have to build out, period. And there is a transition going on to decarbonize the grid, and that's going to continue on, and everybody everywhere uses utilities, period. REITs, you got to narrow it down to what type of REIT. Apartment REITs, Canada, good. US, not as great as Canada. So, it depends on the type of REIT and where and what country you're in specifically. But utilities, easy. That's an easy one. Not only that, the dividend from the utility is taxed lower than the dividend from the REIT, because the utility pays tax. The utility is a taxpayer, so when you get your dividend, there's already tax on it, so it is what's called a qualified dividend. Whereas with the REIT, it's not a qualified dividend. The whole thing is taxable, so you have more tax efficiency with the utility. Any comments on Druckenmiller Tudor? I think I talked about that earlier. Any reason why you wouldn't want to hold a Canadian REIT in an IRA account? The currency risk is the only reason I can think. A Canadian apartment REIT, I think, is a better investment proposition than the U.S. REIT. There is no withholding tax because Canada and U.S. has a tax treaty, and if you're holding it in your retirement account, the tax treaty says we're not going to do any withholdings. As long as it's in a registered account, there are no withholdings. Okay, so you'll get the full dividend. And Canadian apartment REITs, I think, are better than U.S. apartment REITs right now. But other than that, it would be the currency risk. You're holding a Canadian dollar, and you need to retire on U.S. dollars. That's your risk. Screaming buy, referring to the spread between 10-year and 30-year FRM. How can one trade this spread? Well, you trade it with either mortgage REITs, with either MBB, which is a ETF that holds mortgage-backed securities, or you just buy a mortgage-backed security. What's the rationale behind comparing the 10-year bond and the 30-year FRM? Because mortgage rates are set off the 10-year bond, and because a 10-year bond's a bullet bond, coupon, principal, whereas a mortgage is interest is coupon principal. So the principal declines over time. And it works out that the duration, because of that, the duration of the 30-year fixed rate mortgage is very close to the duration of the 10-year. Very close to 10, I should say, not close to the 10-year, but it's closer to a 10-year on tenor than any other tenors. Here we are Monday, and I read Arbor Trust director discloses about 80K of shares. That happened last week on Thursday. That came out on Thursday in the morning. So it was Friday. It wasn't until Friday that you had the sell-off. And 80,000 shares, that's not a lot. Considering how many shares ABR has out, that's not a lot. Really, it's not a lot. Already answered this one. Where can I start reading on philosophy? Any introductory philosophy textbook or YouTube. Type in, philosophy lectures, and make sure it's from a good source. Any university that has, and there's lots of professors from universities that have their philosophy courses online. Any of those are all good. How do you derive the probability of a rate hike? Just go to CME or Google FedWatch tool, and CME will give you the probabilities. Huntington Bank is hot garbage. Well, I think that is in response to the understanding banking videos I did, where I used Huntington as a case study. And as far as a case study, who cares, right? Who cares what I use? When you are using just a really good company, you may not learn as much as if you were using a company that isn't that good. So in the pharmaceutical space, when I put that video out for brand names, I'm using Pfizer. For generics, I'm using Teva. Teva sucks. Teva's had a lot of problems. They've done some restructuring. They had a sort of a presentation they did earlier in the year. I think it was in May. And they're dropping off some things. They've been shutting down factories. Teva's not great, but it doesn't matter when you're doing a video like this. Who cares what the company is? The goal is, can you understand it? Not, none of these are recommendations. I'm not recommending to buy Teva or to buy Pfizer. In fact, in this video, I'll be using McKesson, CVS Health. Heck, there's a couple in there. Cardinal, McKesson, the company that used to be AmerisourceBergen. I mean, because they're all just examples of businesses in different parts of the supply chain. Because the video is about how do you go from the lab to the bloodstream. And we're going to follow a drug, or at least try to understand the pharmaceutical and biopharmaceutical industry from lab to bloodstream, and who are the players in this along the way, and who gets the most value when you're looking at generics, brands, biologics, biosimilars, and let's not forget specialty. So you have 5 different categories, and they're all done in a lab, and they all end up in the bloodstream, but there are companies along the way. Well, it's a complex chain, and the U.S. has the most complex healthcare system. It's a complex chain that we want to understand. Who cares? I mean, who really cares what companies I'm using? So for understanding banking, I just grabbed a stock that was in the banking ETF, that was in the XLF. Didn't care, and I started with a regional. I really didn't take a lot of time and dive deep and say, let me find a winner here. Let me just find one. And Huntington is there. I don't know that I would call it hot garbage, though, but that's it.